الله الشيطان الرجيم بسم الله الرحمن الرحيم رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. Now, yesterday we were talking about the financial statement, and yesterday we covered the balance sheet in detail, and we talked about the components of the balance sheet. We said that the balance sheet has the what? It has one part for the assets, one part for the liabilities, and we also have a part for the equity. As for the assets, we have the current assets and the fixed assets. Then with the liabilities, we have the current liabilities or the short-term liabilities and the long-term liabilities. Then you also have the equity. So today, we shall be covering the last part of this financial statement, and this is the cash flow statement. So yesterday we had already started talking about the cash flow statement. So this is the last of the three financial statements. So the first one is the income statement, which is the profit and loss account. Then number two, we have the balance sheet. Then lastly, we have the cash flow statement. Now, so what is the cash flow statement? So it's a financial statement that aggregates, aggregates means brings together a company's cash inflows and outflows from three things: operations, investing, and financing over a set period of time. So the cash flow statements, that is the definition of the cash flow statement. The cash flow statement tracks the movement of cash in and out of a business, categorized into three main sections. So the cash flow statement has three parts. Number one, we have the operating activities, as we shall see later. Number two, the investing activities. Then lastly, the financial activities. This statement, that is the cash flow statement, reflects a business ability to do three things, as we said yesterday. Number one, the ability of a business to generate cash to fund its operations. Remember, in a business, you have a lot of operation, and this operation, they need some cash. So the cash flow statement will actually enable us to know if, as a business, we are in a position to run our operation. Number two, pay its debt. So the cash flow statement also help us to know, are we as a business in a position to meet both our short-term and long-term obligations? Then lastly, reinvest in the company. So because when you want to invest or reinvest, you need to have cash, you need to have money. If you don't have money, then it is going to negatively affect your business. So the cash flow statement will help us to understand all these things. Now, so there are how many activities? There are three activities. So let us start by explaining each and every activity. Number one, the operational activities or the operating activities. So what are these operating? So this section in the cash flow statement include cash flow from the core business operations, including cash receipts from customers and cash payment to suppliers and employees. It essentially shows how much cash is generated or used up in the day-to-day operation of the business. And that's why it is called operational, tashghiliya. So it basically tells or help us to do what? To analyze the cash inflow and outflow from our daily operation. For example, number one, cash receipts from sales. Every day, hunaka al-mabi'at, things that we normally sell. So we need to know how much money came in from our sales. If you're having a business, every day you are selling something. And when you sell, there is cash coming in. So we need to record that amount. Number two, cash payment to supplier. As a business, you normally have suppliers. They supply you with products or service. So when they do that, money goes out, cash goes out. So we also need to record that. Then number 3, cash payments to employee. We have workers who are working in our organization, our businesses. They don't work for free. They need to be paid at the end of the month, or sometimes they need to be paid on a daily basis. So that is cash outflow. Then we also have other operating cash flow. For example, income from investment, money that you get after investing in something. So these are the key items you will always find in a cash flow statement under the operating activities. Number 2, in the cash flow statement, you will also find investing activities. So this section reflects what? Cash flows related to the acquisition and disposal of long-term assets and investments. It indicates how much money the company is investing in its future growth. If you're having a business or if you're running a business, sometimes there is some money you allocate this money for investment, future investments. They include, number 1, purchases of property, plant, and equipment. So this is cash flow, anything you are buying. Cash spent on acquiring physical assets. For example, if you are having a business, when you buy a car, you are investing in a car, right? So this is money is going out. You are spending it on something, on an asset. When you, for example, you're buying furniture. So when you are acquiring any physical asset, we need to record that money is going out, cash outflow. Cash received from the sale of assets. Sometimes as a business, we normally sell assets. We normally sell our assets. So the money we get in, the money that comes in, needs to be recorded. Then lastly, investment in securities or other businesses. Money spent to acquire stock in other companies or invest in projects. So this one is also written in the what? In the cash flow statement under the investing activity. Sometimes you go and buy stock. Sometimes you buy shares in another company. Okay, or sometimes you invest in other projects. So the money that you use in that process needs to be recorded. So net cash from investing activities shows how much cash was spent on investment versus how much was earned from selling them. So how much did we spend on investment? That is money, cash outflow, and how much money was earned from selling these assets and our investment. Then number 3, in the cash flow statement, you will also have the financing activities. So this section includes cash flows related to what? It includes cash flows related to financing the business. So it shows how a company raises and pays back capital through loans, equity, and what? And dividends. So here, basically, for any business, you will require money. Okay? And this money, where are you going to get it from? So there are both internal sources and there are external sources. If you want to get money internally, you can issue stock, you can sell the stocks. So cash inflow from selling shares of the company. So if as a company we need money, what do? We sell the shares of our company or the stocks. And in return, money comes in. So that is the meaning of what? That is the meaning of cash. That is the meaning of the financial activities related to the issuance of stock. So selling, or when we are selling our shares, money comes in. Number 2, borrowing. Sometimes, like we said yesterday, you are having a business, but you don't have enough money. So what will you do in that case? You will go to a bank and ask for a loan. So cash inflow from taking out loans or credit. So any money that comes in, so that is cash inflow from the bank, or sometimes you get credit from your friends or partners. So these are cash inflows and they need to be recorded. Then sometimes repayment of debt. When you take the loan, you'll have to pay back. That is cash outflow. We need to record that money. So you are going to repay the loan, you are going to pay back your creditors. Then lastly, there is dividends paid. So cash outflow to shareholders as profit distribution. So if you are having a company, of course, as a company, you normally have shareholders. And shareholders, these are the people who do what? Shareholders, these are people who do what? They've invested in your company, they have shares. So when the business is doing well, or when you get good profits, you give some dividends to your shareholders. So you give them some money. So this is cash, it's cash outflow because you are giving them something out of your pocket. Now, net cash from financing activities summarizes cash raised from financing minus cash used to repay debts and pay dividends. So it's basically the money that we received from the banks, our creditors, minus the cash used to repay them. Now, so what is the summary of the cash flow statement? At the bottom of the cash flow statement, as we shall see, you will find a total figure that represents the net increase or decrease in cash from the three activities, the operating, investing, and financing over the reporting period. This figure is then added to the cash balance at the beginning of the period to arrive at the ending cash balance. So we'll see this practically. Later, we have an example for this. So number one, what is the importance of the cash flow statement? Why do you need to have a record of your cash inflow, cash outflow? Number one, liquidity assessment. It provides insight into the company's liquidity position, showing whether the business has enough cash to meet its obligation. So the cash inflow outflow statement, it enables us to know, do we have enough money to meet our obligation? If the answer is yes, then it means we are in a good position. If the answer is no, then we have to go back to the drawing board. Number two, operational efficiency. So companies can analyze how efficiently they generate cash from operation. So as in a company, there are a lot of operations. In a business, you have many operations happening. You have marketing, you have production, there are many operations happening. So the cash flow statement will help us to do what? The cash statement will help us to know which operations are bringing in a lot of money and which operations are redundant, which operations are not helping us. Investment decision number three. So investors can gauge how well a company manages its cash and its ability to fund growth and sustain operation. Today, if I want to invest in your company, I will ask you for your cash flow statement because I want to know if you are prudent enough. I want to know if you are good in managing your what? Managing your cash. If you are not good in managing your cash, then I cannot invest in you. Now, here is an example. So this is how you prepare a cash flow statement. So this is a cash flow statement of ABC company, okay, for the year that ended December 31st, 2023. So these details, they are very important. So number one, as I was telling you, in your cash flow statement, there are three activities. So you can see in purple, the cash flow from operating activities. In green, we have cash flows from investing activities. Then lastly, we have cash flows from financing activities. Then down here, we have the net cash from financing activities. Okay. Then the most important thing is the net increase in cash. The net increase in cash. If this figure is positive, it means that we are excellent in managing our cash. But if there is a net decrease means at the end of the year, we have a deficit, we have a negative number, which means that we cannot be able to meet our obligation. That is, the company is bankrupt. We don't have enough cash. Now, so the cash flows from operating activities. Number one, cash received from customers. Mabiat. Sometimes we sell, we get money. So this is money that is coming in. That is why it is positive, 50,000. Number two, cash paid to suppliers. It's cash outflow. It's going out. That is why it's in brackets. So in brackets means it is negative. Okay? Because it's cash outflow. We are paying. It's going out. Cash paid to employees. When you are paying salaries, we are using our money. Our money is going out. So this is also the negative number, 15,000. So the net cash from our operating activities will be 50,000 minus 45. So we have a positive number. So net cash from operating activities is how much? It's 5,000. Number two, let us now go to the cash flow from investing activities. So number one, we purchase. We are investing, so we buy something. We buy a car, we buy a machine. When we are buying, the money is going out, cash outflow. So that is minus 10,000. Then cash received from sales of assets. So after some period of time, we sell some of our assets, then cash comes in. So what we sell, the money we get, of course, is positive. But now the difference between the two is negative. So the net cash from investing activities is minus 15,000. Then number three, cash flow from financing activities. So number one, cash received. So we sold our shares and we got some money positive, that is 20,000. Then we repaid some loan. When we are repaying loan, we take money is going out, so that is negative 8,000. Then we also paid our shareholders some dividends. So when you are paying anything, it's going out, so it's 4,000. So the net cash from financing activities is what? Is 8,000, which is a positive number. So our net increase in cash is what? Is 8,000. Is 8,000 because net cash from operating activities is 5,000. So 5,000 minus the 5,000 here from the net cash from activities, it's 0. So we're just going to work with this positive number, 8,000. So the net cash from financing activities is 8,000, which is also going to be our net increase in cash, 8,000. So once we get this 8,000, we add this amount to the cash at the beginning of the year. So at the beginning of the year, what was in our account? What amount did we start with? It was 10,000. So now cash at the end of the year, we have 18,000. So it basically means we are okay because the figure is actually what? The figure is positive. But if the figure is not positive, then it means there is a problem somewhere. We have a deficit. It basically means the cash outflow is more than the cash inflow. And it also means that we cannot meet our obligation. So if you are having your business and if you want to easily know your cash flow, this is how you can group, this is how you can classify, or this is how you can. So for any kind of business, they'll always have these three activities: operating activities, investing activities, and financing activities. So good businesses, they know how to manage what? To manage all these activities. Now here they're just explaining to us, they're just explaining what I was telling you. So the cash flow from operating activities, they are explaining how they arrived at these figures. So this is just but an explanation. Then also cash flow from investing, they're also explaining to us what is happening in this. The green one, the cash flow from investing activities, they're explaining, so you can easily read it during your time to read and understand exactly, to see what is happening. Then cash flow from investing activities, the same thing. The cash flow from financing activities, they are basically explaining each and every item that we've just seen. And of course, the summary is there. So this line summarizes the overall cash inflow and outflow from all the three sections. In this case, the company had a net increase in cash of what? 8,000. So that is what yesterday we did not cover. We did not finish this part. So that is the what? That is all about the cash flow statement. Now this is the last topic in our course. So this is the last topic we shall be covering in our course. The last topic is known as the financial statement analysis. This topic is very important because 80% of your final exam will come from this topic. 80% of the questions will come from financial statement analysis. So next week we will start covering it now. Then the other half we will cover on Thursday. Then on Friday next week, inshallah, you'll be having your quiz. So the quiz next week, your quiz will cover the first four modules: Module 1, Module 2, Module 3, and Module 4. Okay? So your quiz will cover Module 1, Module 2, Module 3, Module 4. And the quiz will be out of 20%. So you'll have 40 questions. These 40 questions, 40 marks. Then at the end of the day, I will divide it by 2. So 40 divided by 2. So you'll just review the first four modules: Module 1, Module 2, Module 3, and Module 4. That is what will be in your quiz. Then for the final exam, it will be Module 5 and 6. Only 2 modules. The financial statement, that is the income statement, the balance sheet, and the cash flow statement, plus this topic, the financial statement analysis. So those 2 topics will be in your final exam. So when you are talking about the financial statement analysis, already we have those 3 statements. We have the income statement, we have the balance sheet, we have the cash flow. So we need to analyze the items in those financial statements. So that is what is called the financial statement analysis. So we are going to have some ratios that are going to help us to understand actually in detail the balance sheet. For example, there are some ratios related to the balance sheet. There are some ratios related to the income statement, and some ratios also related to the cash flow statement. So that is why it was important to have a background of the financial statements, because if you don't know the financial statement, it will be very hard for you here. Now, what is financial statement analysis? So these are the items that we'll be covering in this last module. So we shall be analyzing financial statements. We shall see the types of financial statement analyzed, importance of analyzing these financial statements, types of financial analysis, financial ratios, importance of financial ratios, types of financial what? Financial ratios, then steps for interpreting financial statements. So this is what we shall be covering today, inshallah, and on Thursday. So what do we mean by financial statement analysis? So it is the process, Amalia, the process of analyzing a company's financial statement for decision-making purposes. So already we have those three statements. The next thing is to analyze those three statements so that we can make some decisions. Now, what is analyzing this financial statement? So analyzing financial statement involves reviewing, muraja, reviewing and evaluating, takim, the financial information presented in the statements of a business. Why? Number one, to assess its performance. Number two, its financial health. Then its viability. So these three things are very important. So we are analyzing our financial statement to know how our performance is. Are we doing okay or we are not doing okay? We need to know our financial health. Do we have enough money to sustain our business? And viability. Viability and financial health are almost the same. Viability means, are we visible? Can we sustain our business in the next maybe 4 to 5 years? So this process utilizes various techniques and metrics to interpret the figures, revealing insight into the company's profitability, liquidity, efficiency, and solvency. So we have different ratios. So as we shall see next week. So for example, we have profitability ratio. How do we calculate it? You need to know how to calculate it. Liquidity ratios, we have them. We have ratios for efficiency. For example, the return on investment, the return on assets. And we also have some ratios related to solvency. Solvency, for example, the debt to equity ratios. So we shall cover all those. Now, the types of financial statements analyzed. So we are going to analyze these three types of statements. We have already explained, so I'm not going to explain anything here. So these are the three financial statements we are going to analyze. Now, why is analyzing this financial statement important? Why do we have to analyze them? Number one, investment decision. So investors, if they want to invest in your business, they'll have to analyze this your balance sheet, your profit and loss account statements to know if they can invest with you. So I cannot invest without analyzing. Number two, credit evaluation. For example, when you go to a bank, the bank will ask you for this statement. The bank will analyze, especially the debt to equity ratio. So from that, the bank will know if we give Mohammed business this loan, they will pay because they have enough assets, ila ghayri dhalik. Now, then we also have the management decisions. The management, they normally have to make some decisions related to operational activities in the business. So they have to do what? They have to analyze this statement so that they can make informed decision. Then also performance assessment. So when we analyze this data or when you analyze this financial statement, it helps us to do what? It helps us to know or assess our performance. For example, in 2024, what was the performance compared to 2025? What was the performance in 2024 as compared to 2023? Then we have regulatory compliance. So companies must provide accurate financial statement to comply with legal. So it's a requirement, as we saw, it's a requirement by government for businesses to always present accurate, verifiable what? Financial statement. Stakeholder communication. So by analyzing this financial statement, companies can communicate their financial status to shareholders. That is why at the end of the year, you normally you normally have an AGM with all your stakeholders, and you share with them the audited, analyzed financial statement. If you don't do that, they will lose the trust from you, and some of them might even withdraw, you know. Now, so that's the end of our lesson. So in our next lesson, we shall start in the types of financial analysis. That is where we shall start in our next lesson next week. So we still have one more lesson to go. So if you have a question, you can just ask now as I take the attendance. If you have any question, as I take the picture, if you have any question, you can just let me know. Okay, ask your questions, please, if as I take the attendance. If I also take a picture from your side, if you not see your name in my list, you can remind me, you can send me a copy, because sometimes I might not capture. So ensure you have your evidence that you have attended the class. Okay. Yes, there is a message here. So there is an internet, no problem. So is there any question, please, before we leave? So if there is no question, we'll meet inshallah next week. Okay, thank you. Assalam. Okay, Abdulaziz, Assalam. Thank you.